So far, 2025 has seen some strong performances from stock markets, especially US ones. Joining me today to look at global markets is fund manager Philipp. So Phil, maybe to kick us off, you can remind us how PSG Asset Management approaches managing global portfolios.
Hi, Audrey. So in essence, we follow a bottom-up approach where we try to buy companies with inherent qualities, for example, a strong moat or management team, that are being underappreciated by the market and are therefore trading at a wide margin of safety. We call this our 3M investment process of moat, management, and margin of safety. Now, this focus on margin of safety means we tend to shop in uncrowded areas where we think the chance of finding mispriced securities is higher. We also generally take a longer-term approach where, on average, we've held our investment companies for about 4 years. Now, we obviously want to do this in a responsible way and construct portfolios that are diversified across geographies, industries, and return drivers.
So Phil, I think the big story is the way in which US markets has continued to defy expectations so far. And many people are wondering for how long this can continue. So if we look at markets currently, what is changing and what should investors be aware of?
Well, firstly, I think it's important to note that very few kind of trends last indefinitely. And I think we've argued for quite a long time that especially post-COVID, we've seen significant inflections in certain important areas such as monetary policy, inflation, and geopolitics. Now, when we look at the US market, for example, we're currently seeing index concentration where the largest stocks in the index dominate the market, conditions that kind of rival the conditions we saw in the 1970s and the dot-com bubble. Also, the US President Trump made it quite clear that he wants to see a weaker dollar policy, which has big implications to liquidity constraints and conditions in markets outside the US and emerging markets in particular. The policies we're currently seeing also made it quite clear that several countries, such as Europe, or several markets like Europe and China, are kind of being forced to sit up and try and get their own house in order. And we've seen Germany, for example, embark on significant fiscal and infrastructure policies that has implications for companies in these markets. Now, your question was about the trends we've seen in the US, but importantly, the implication we've seen for the year. When we started 2025, investors went into the US kind of all in. Positioning was extremely positive towards the US. And it's actually been markets outside the US that have outperformed the US market this year. And by example, global stocks ex the US have actually delivered a return of 26% compared to the S&P's return of 15%. And to many people's surprise, it's countries like China that have delivered well, returning 37%, or Brazil 40%. And even our own South African market, the MSCI South Africa index is up 55% in US dollars.
So looking at the market, are there any risks that investors should be aware of, and what should they take into consideration when positioning their portfolios?
Yeah, so we're currently seeing, as I said, many inflections. And inflections and regime changes, we think, are usually, well, they're never calm, I think, to put it mildly. And despite markets currently being dominated by the AI narrative, I think the way we think about the world is that the winners of the future are more likely or less likely to be the ones of the past. Also, if you're looking at the big trends that are happening currently, I talked about currencies earlier. If you're a foreign investor, for example, in the US market, let's say you're a European manager reporting in euros or a South African manager reporting in rands, you've actually only delivered returns of 1% or 5% from a US portfolio year to date to the end of September. Now, if you're going into a world where you can start harvesting returns in areas other than US tech, you're probably going to start reassessing your all-in positioning in the US market. Now, the risk this kind of brings and the headache I think it can cause investors currently is that the stocks that have dominated the index at an index level are all exposed to the AI theme, and they happen to be US companies. These stocks are, however, pricing in very rosy expectations, which, if they fail to deliver on them, could leave investors quite exposed.
So taking that into consideration, where are you finding opportunities for investors going forward?
Yeah, Audrey, I think we are currently seeing a massive opportunity in parts of the market that have been out of favor. We think you can construct portfolios that should outperform at low levels of risk, while large parts of the market are highly crowded and popular. Now, by extension, this means our portfolios currently have reasonably low exposure to US assets, but we're finding great opportunities in areas outside the US, ranging many industries and countries. To give you some examples, this ranges from Asian life insurance companies to global brewing stocks and spirits companies. We're finding great investments in the commodity space, ranging from natural resource companies and energy stocks. We're finding good opportunities in the emerging market space, in consumer emerging market companies and banks. And more recently, we found some good ideas in the German stock market, chemicals producers, and also in the US, actually, the US healthcare sector. Now, despite the market trading kind of near record highs, there's actually not a shortage of opportunities if you're willing to invest into areas that aren't in favor currently. And when we're looking at our global portfolio currently and compare that to the MSCI World Index, for example, not only are our stocks a lot more diversified than the index, they also trade at a large valuation discount to the index and offers earnings growth that we expect to be very strong in the years ahead.
So Phil, what value do you think does a bottom-up manager like PSG Asset Management bring in an environment like the current one?
Yeah, it's a good question, especially if you look at the last decade where passive strategies and the index has performed so well. What does an active manager really bring? And we believe in the current environment where stock markets are dominated by few sectors and stocks and are trading at historically higher valuations and expectations, an active manager like ourselves that's willing to invest into areas that are currently out of favor but should do well in the future will add a lot of value to investors' portfolios. As an example, even in the last 5 years, where we've looked materially different to the index and haven't had exposure to a lot of that AI narrative, our funds are actually performing very well and have delivered those returns actually at lower levels of drawdown than the index. And we think the environment we're going into, active managers, but those managers that are truly active, that are able to differentiate themselves from the index and peers, should add a lot of value to client solutions and portfolios.
Phil, it's been great chatting to you. Thank you so much for joining me today.
Thank you, Audrey.